Everybody, thank you. Recording. All right. Good morning, everybody. Welcome to the commercial meeting of the Co-Banker George Realty. I'm happy to see a lot of familiar faces today. And I am also happy to report that our commercial department has done really well in 2022 so far. In January, we have a $22 million warehouse, double-ended in our company. And in February, one of our agents in Arcadia, Amy Wong, was ranked number 2 in the nation co-bank commercial as far as performance is concerned. So and in March, one of our listing, office listing, was featured in the elite commercial CB commercial, and in a matter of 1 month, it was sold for $14 million. And just yesterday, we have another double-ended warehouse deal for $14 million. So it's pretty impressive so far. As I said, the commercial real estate can be lucrative sometimes. Just imagine, for example, the deal that we had yesterday, that the $14 million warehouse. We have a total commission of $616,000 to be split between 2 agents within our company, and I'm sure that they're laughing they're laughing their way to the bank, which is not a small change, for them to have as a commission for one deal. But in order to be a commercial agent, you have to have the credibility. And also you have a good presentation. So, sometimes it's better to team up with somebody who is experienced in the commercial real estate. That's why we have a mentor program where I can pair you up with a mentor that's more experienced, and you can work the deal together. And they can walk you, step by step, and hopefully you will learn along the way and become a more experienced commercial real estate agent later. And if you are interested in this program, let me know, and I can arrange to have it pair you up. Okay, and another thing that important is the knowledge, and when that comes to knowledge, CoStar is the Bible of the commercial real estate. He has so much information, and so the app was so easy to use, and everything is in your fingertip, and it can really help you do good presentation before your clients. And this year we have a special from CoStar. Now for $360. For $360, you can have the access to the nationwide data plus Canada and UK. Okay, so if you, it's very remote that you ever sell property in UK, but if you want to browse around some of the properties in Canada or UK, you can also do that, and you'll have the whole nation to get access to also. Before we can, in the Co-Banker Georgia, we can only access 4 counties. So this is a tremendous expansion of the data, or the area that we can get data from CoStar. So it's a very good opportunity for you to join. And if you are interested, please let me know. And we have until next week as a deadline to join. So, if you are thinking of serious about going into commercial real estate, CoStar is a must. So you let me know, okay? Now we come to the main reason why we came to the meeting today. That is to hear Dan Spiegel talk about commercial real estate. Now, Dan came to us about 6 months ago, talking about why and how to become a commercial real estate agent. Today, he's going to talk about the trend of commercial real estate, and also the development of commercial real estate, including like converting the office space to residential houses, and other areas like the interest rate, how the interest rate impact real estate business. Now, Dan is so famous, and it really doesn't need much introduction. But suffice to say that he's one of the pillars in the commercial real estate in core banker, and he is very instrumental in propelling the CB commercial into national prominence. And more importantly, he's very cordial, very amiable, and very down to earth and eager to help. So anytime you call him, hey, he's very friendly. You can tell with his smiling face.
Yes.
So without further ado, let's welcome Dan Spiegel. Dan, take it away.
All right, no problem. Thank you so much, Peter. Really appreciate it. And I will say, just to reemphasize, I mean, CoStar, some people say is really expensive, but I will tell you, you look at the $300 a month, which is, $360, whatever it is, Peter, you could never replicate that. Nobody can. And no CBRE, JLL, no one does. For $360, you get the entire country, not to mention Canada and the UK ownership available. It's really crazy. So, yeah. All right, I'm going to do, if I click share here, I'm going to make sure this all works. Should work in a moment. You should see my screen.
Yes.
And then I lose you, unfortunately. I can't see you guys, but let's see if I can do that. And I can see a couple of people here. Okay, so you can see my screen. Great. So thank you, Peter. It's great to be back with you again. And this, we're going to, as you said, last time we talked about getting into commercial real estate. This time we're going to talk more about trends in the market, and just gives you some things to think about. This is interactive, so feel free. I don't know if I can see chat. I have to, I don't know where chat goes. So feel free to unmute and ask a question. How's that? It's easier than me to try to chase down the chat. But I'm going to share some comments about where we're at in 2022. I mean, this is a marketplace, like residential, that's changing frequently just because of economic conditions. But let's talk through some of it together, and I'll share some of the observations. Now, a lot of these observations come out of our 2022 Coldwell Banker Commercial Market Report, which we published in January. It's available on the CBC Worldwide website. It's a PDF. You can download it. You can read it. You can share it with clients. So it's out there for you to use, certainly. And we will do an update come mid-year. So we'll have a revised look at the outlook for 2022. As I should also say, as Peter mentioned, it's a nice, I know there's challenges, let's say, in the residential market with interest rates and inventory. And the commercial market has challenges as well, but our business is quite robust. Revenue as a CBC enterprise is up significantly in the first quarter. I want to say it's up 40% or something like that. So thank you to Amy and the others in your group that did transactions. That helps accelerate our business nationally. But let's just talk through some of the trends going on around the country. So I'm going to start this out by sharing with you questions I've asked to some of the audiences I've presented to. You don't necessarily, I'll just ask you what you think the answer was. But let's go into that. So let me make sure. There we go. So the first question I asked, I said, if you're an office occupier, if you're an office space user, you're a business owner and you have office space, do you anticipate taking more space in the next 18 to 24 months? So that's a question I asked the audience. And let me just ask this to you. What do you think the answer is if you were giving the answer? What do you think if I asked 100 people in an audience, what would the answer be today?
Probably no.
Probably not. Steve says probably not. Anyone have a different opinion? Yeah. So that's Steve's, I won't say Steve's right on answer, but thank you, Steve, for answering. But office space is still very much in flux, right? What is the future of office space? We don't know, and that's something we'll talk about in a little bit. I think you find in most markets, modern, I'll call modern, let's say built in the last 20 or 30 years, office space is still quite in demand, but they're starting to be, let's not even call it that much older. So it was built in 1990 or 1980 to 90. That's only 30 or 40 years old, which I guess relative to myself, I don't think is terribly old. But that space is starting to be obsolete, and the firms that are consuming space want the latest and the newest space. But Steve, yeah, you're right that most of the people in the audience, I had one person raise their hand, they might take more. That's great. I mean, I thought business is expanding, but by and large, people are kind of holding steady. But then let me just ask the other question. I said, okay, if you're an industrial user, so for you do distribution, warehouse, manufacturing, anything, what do you think the answer from the audience of 100 people might be?
Expand.
Yeah. Anybody else? Anyone else have a thought? Generally, the answer is something like, I can't get enough industrial space, right? There it says, I can't find any industrial. I think if you go to your market, Peter, I could look on the CoStar report. I'm going to guess like in the Inland Empire, the vacancy is less than 0.5% or something like that. It's going to be quite low. And that's probably true in most industrial markets. So really a dichotomous world out there in commercial real estate, just using those two examples. So let's just go through some of the findings that we had in our CBC 2022 outlook. So first of all, and Peter, you mentioned this in our discussion a moment ago about residential, some of the same dynamics exist in commercial, which is, the whole economic upheaval of the past 2.5 years was not a real estate problem, right? It wasn't a real estate recession. It wasn't like 2008 and so forth. It was a virus, right? It was a different kind of problem, right? It did exacerbate some trends or accelerate some trends in commercial real estate. But bottom line is there's still very strong fundamentals in commercial real estate. And Peter, again, to your point about residential, at least in Southern California, there is still a lot of pent-up demand for investment real estate or for user real estate. Again, aside from segments like office space, by and large for investor, for multifamily, self-storage, and whatever, there's a lot of demand. So let's just touch on a couple of those things. So first of all, strong fundamentals in commercial real estate. If anyone disagrees, raise your hand and speak, but I think by and large, people are still bullish about rent, growth potential. Certainly, one thing about owning a leased property, if your leases are tied to the CPI, Consumer Price Index, guess what? As inflation goes up, you're not going to lose out, right? If you did negotiate and your leases are tied to a fixed rate, like 1 or 2 or 3% a year, you might have some negotiation to do or perhaps restructuring of leases. But fundamentals across the board are pretty strong. There's no lack of lending in commercial real estate. We do see cap rate compression. So, that point in time measurement, the cap rate of return on the investment has continued. I'll show you a graph in just a moment. And that has driven investors to look outside of their comfort zone in terms of other property types or other geographies, trying to find the cap rate that suits their need. Which means investors are willing to take on a little bit more risk than they would have in the past. Someone might have been comfortable only investing in California or California multifamily, and now they say, geez, I just can't either find the product or get the return. I'm going to look to Nevada or Arizona or rural Colorado or something like that. They're going to stretch their boundaries and they're going to ask their broker to help them find opportunities that meet their need. For those coming out of investments and 1031 exchanges, there is not enough 1031. I don't know if anyone's representing a 1031 buyer right now. If anyone out there, tell me your story. But by and large, 1031 buyers are scrambling to find product to invest in. It is not easy to find product, particularly if you're looking for a net lease, like a freestanding Starbucks or Wendy's or something like that. Those things are, they trade almost like bonds. They are. So if you have a listing on that, it'll sell, as Peter said, or Steve, you mentioned in your house, a net lease listing on a freestanding, good located retail center will sell in an instant for sure. Build to rent. I don't know if this is a phenomenon of Southern California, but it certainly is of markets that have a lot more land to develop on. Build to rent has attracting a lot of capital from institutional investors that would have traditionally gone to multifamily, right? It's now a new alternative class to multifamily. That the Blackstones and so forth, the Invitation Homes and those kind of people are in the market again. And you guys, I don't know in Southern California if it's as popular, but there's some controversy around it. But investors are welcoming the opportunity to build and buy only to rent residential developments. I think part of it provides more liquidity, right? Whereas in a multifamily, you have to sell the whole property, right? If you want to cash out of the investment. Whereas if you buy 50 homes, you could potentially sell them out one at a time, right? You don't have to exit. So that's a trend that's continuing this year. We talked about office space earlier. Just given the uncertainty, there is uncertainty in office space, but the demand for small office spaces, 2, 3, 4, 5,000 square feet is still out there, because I think by and large people are willing to commit for a couple thousand square feet of space. It's just harder to commit for 100,000 in downtown LA or Pasadena, right? MedTail to the rescue. So while the retail market is really turned around by and large, a couple of uses have really soaked up some of the retail space. So one is what's called medtail. Medtail is sort of the marriage of medical office or medical use and retail. So these would be things like cancer treatment centers, dialysis centers, spine clinics, all that kind of outpatient type work. I'm going to guess if you drive around your area, you will see a fair amount of medtail in retail centers that historically might have gone to locate next to a hospital like Huntington or Methodist Hospital right in your area. But instead they're going into retail centers, and that's propping up retail centers quite well, as some of the retailers have been driven, out of business by competition from the Amazons and the like. Anyway, all this is found on the Worldwide website. You can download it, but those are the fundamentals. And I think as we get ready in a month to write the mid-year report, I don't think there's much here that's going to change. I think this is probably going to stay pretty static, but we'll see when we start talking around the network. And if you have trends in mind that you'd like to share with Europe, please share them with myself or Jane Thorne-Leeson, because we'll come back to you when we do our interviews to do the mid-year report.
Dan, I have
Yes.
a question. When you mentioned that you see more tolerance for the investor for risk, what is the reason? Why is it 1,000?
Because they can't find the product they want in the geography they want, or they can't find the returns that they want. So when I say risk, the risk could be, I'm willing to go to markets I don't know as well to find that return, because I have money to invest. What am I going to do? Put it in the stock market the stock market's down this year. It's still very high, right? And especially if you're just testing your comfort zone. I think you're testing, and the further we get away from everything, I assume everyone on the call knows that real estate goes in cycles, and there will be a down cycle in the future, right? The further you get away from the last cycle, the more that people kind of think, well, it's not going to happen again, or it won't be as bad, right? So memories start to grow long, and I think people tolerate more of the risk.
And also you mentioned about the build to rent instead of development for sale. What's the pros and cons, and what is the advantage of build to rent?
Well, as I said, it's what's interesting in the past 12 months or 18 months, it's really the institutions that have really driven the build to rent market. I think, I would imagine there's build to rent, buyers out there in Southern California, although it tends to be more, attracted to markets like Atlanta and kind of big development markets where you can build 150 homes. But I think it's the opportunity. There's a shortage of housing in America. I think we can say that for whatever the reasons are. And people do want, especially millennials, which are the largest demographic group, need to move up to more space because they're at the age when they're marrying or settling down or have families, and they need space. They can't buy or they can't afford a house, right? The logical thing is to rent one, right? And as an investor, as I said, you might have, one thing is to buy a multifamily complex with, 60 or 80 units. But then you have to sell all 60 or 80 at the time you want to cash out. When you buy 60 homes, you potentially can turn those homes over one by one if you feel like it, right? So it adds a little bit different liquidity.
Yeah, and more and more even the smaller developer prefer build to rent instead of develop to sell. Maybe mainly because of the capital gain issue. They think that if they can wait a little bit longer, then the capital gain will not service at the time when the project is finished. So.
Right. Yeah. We have a broker actually in Atlanta that I met recently with CBC, and he, as much as I think of build to rent as, kind of modern, just constructed homes and stuff, he packages 20 to 30 homes at a time in the Atlanta market, primarily from people who bought them during the last downturn in housing. So there are, I guess what I didn't know, he explained to me, he says there's a lot of people that own 20 and 30 homes out there. That it maybe, I'm not familiar with that, but he says, he goes around the land. They're not high $1,000 homes, which, in California would be 800,000 or 900,000, but there are people that own 20 or 30 that are selling from a private portfolio to institutions like Blackstone. Yeah. So I thought that was kind of interesting. I wasn't aware of that. I thought of it as a much larger scale business, but not necessarily.
Okay, thank you.
Yeah, no problem. Appreciate it. All right, let's keep going here. So just let's look at, this is a chart from Real Capital Analytics, which by the way, ranks Coldwell Banker Commercial as number 15 in the country out of 1,200 firms in terms of our market share on property sales. But this gives you a look at property price growth by property type. So I think you can see, I mean, you can look at retail, industrial, apartment, all of them, all of them. What do you see over the last year and a half? Is just a nice steady up curve, right? Or up shape. The ones that we mentioned earlier, office, downtown office, and suburban office are definitely the ones that are relatively looking weaker, right? But there has not been a shortage of price growth for commercial real estate over the past, I'll call it the past 2 years. I think that's probably fair to say, since the low point. Remember, commercial started its recovery from the pandemic scare later than residential. So that's why you see the beginning of the cycle, sort of the end of 20. But I think these are some nice appreciation charts here. Of course, this is for AFD, this is nationally, obviously. All right.
Yeah, Dan, can I ask one question on the
please.
pricing? Is that a price per square feet or what? Or
I believe it, I'd have to go look at RCA source. I believe it's price per square foot, sales price per square foot. Right. So
wow.
100. Yeah. It's really, as I said, you look at the inclines, right? 20% growth in retail, 22% in apartment. It's more shocking than you might think, or it's more remarkable, I should say, maybe.
Yeah, it's shocking to me, particularly on the retail.
It's remarkable. And industrial, and if all the charts, which is the one at the top, industrial, that's what we talked about earlier. Industrial is just, there's not enough industrial space. Again, just like homes in America, not enough industrial space. Yeah, this is updated through March, so this is super recent. Yeah, super recent.
Yeah, very good data.
I'm sorry?
Very good data.
Yeah, so yeah, and you have these slides. So and this, by the way, you can pull it off RCA's site. It's publicly available. I pulled it off. Anyway, so the other thing, I can point to, and I don't have the most recent data on this, but this is sort of interesting. So if you take the blue line, which is sort of cap rates overall, and this goes back 20 years. So this is really a long term, and it's not meant to be an eye chart, so don't stare too closely. But the blue line is cap rates. And as I was saying, cap rates have continued to decline. If you look at the last peak, if you want to say it looks like July of 2009, it's pretty been a steady but not sharp decline over the last 20 years. Okay, but they're still, let's say, reasonable, looks like 500%. But you compare that to the 10-year treasury yield. Now, when developers borrow money to develop, they're not borrowing at mortgage rates like 5%, right? A developer generally borrows on a shorter term note, it's often tied to a 10-year treasury. And as the treasury bills start to go up, which is the orange line, and the cap rates come down, at some point, if those get too close, developers might say it's not feasible. I can't do it, right? So it's interesting. I don't have the most recent data for this, but it is, if you look, the last time it was very close was back in 06, 07, right? And now it looks like and I think if we updated this chart through March, though, there definitely would be a big upturn. I don't know what 10-year treasury, someone can Google quickly what 10-year treasuries are at now. Well, the 10-year treasuries, I guess the good news is they don't really follow inflation. So that's the good news. But the margin's getting smaller and smaller, which should indicate that at some point, investors or developers have alternative uses for their cash, or it's just not economically feasible to invest or buy. I'm not predicting where it'll go, but I think it's an interesting trend to pay attention to, because where things have been apart for the last, last year and a half, over the past year, 9 months, they've started to come closer and closer together, if that makes sense, right? So 10-year treasuries versus cap rates continue to come down, treasuries go up, and then you might get to a point where, investors decide, I can't do it. Or they look for like value add assets, right? They can't justify the development unless they know the rents are going to go up, right? Because otherwise it won't make sense. So that's, I will say just one quick example. I was at a Urban Land Institute event in Chicago, I think it was like a month ago, talking, and I heard a residential, nice high-end class A, high-rise developer. And she says in some of her marketplaces where the demand is, the market will take it, she's raising rents 40%, which 40%. So these are these nice Class A, high amenity buildings because there's nowhere for people to go. And she says, I need to, at my borrowing rate, I need to get the returns per square foot. Not to mention labor prices are higher, energy prices are higher. Think of all the things as a property owner, right, that are challenging. So anyway, there's some food for thought. And so let me just point on a couple trends. So we just talked about general trends in primarily investment, but what's driving some of the marketplace. So first of all, let's go back to the office space discussion, but it's also true of industrial as well. Employees still are in your right rule. Unemployment is still quite low. Employers, you've probably read the stories in the newspaper. I think my friend of mine sent me an article from the Wall Street Journal about donuts are the new thing. Donuts are what's attracting people to the office. And then there was another article, it's booze. Everyone wants booze in the office so they can drink. Employers are doing, the big employers, the bank, they're doing anything to get people back to work because, just not forget they're paying 20, 30, 40 in New York City, $90 a square foot for office space. It's kind of painful to pay that and no one show up. My joke or my measure here is I said, when you go out to dinner, it's very hard to get a restaurant reservation. I don't know if anyone experiences that, but so it doesn't seem like people are afraid to go out. They just don't want to go to work. They don't want to go to the office, which I think is kind of interesting. So that's going to continue to drive location decisions for companies. And businesses are going to have to do whatever it takes to make their employees happy, right? So that could be office space, that could be industrial space as well, and trying to keep their workforce engaged. It also has a meaning for what does it mean to value an office property today. I know, was it Steve, you sold that? I was an office property, I think it was you, down by the 10 freeway. I can't remember now. I can't remember who sold it, but anyway, my point being is like if you were valuing an office property today, office leases are long, 5 or 10 years, so people are still paying rent. But how do you value it knowing that your tenants may be gone in a year or two, right? When those leases expire. So I think there's a lot of challenge to the office market, but employee demand and employee preferences are what's driving it. All right. I think this is super interesting. So what I call real estate fracking. And I bring this up because I don't mean it in the sense of energy, but I mean it in the sense of what I continue to see is more and more real estate ownership is following the trends of things like, other kinds of shared resources like taxi cabs, which are, Uber and Lyft now, where they're getting divided up and allowing more people to participate in the investment process. And also creating new demand that didn't exist, right? So let's just give you some examples. So let me use the example of Airbnb for a second. So that's essentially taking a residential piece of land or unit and dividing it up, and you make more money by dividing it and renting it by the night than you do renting it by the month or year, right? So that's, in a sense, that's a fracking. You break it, the value has gone not from the long-term lease, but to the short-term lease. Now, of course, there's risk to that, but that's in the hospitality space. In the co-working space, if you're a WeWork or any of those lookalikes, again, the operator signs a lease on the office space, but then they divide it up and rent it out, and they generate more revenue than that landlord is getting in the long-term lease for that space. 3PL on the industrial side is the same way. But it's interesting. So now if you look at the investments, there are, so first of all, there's crowdsourced investments.
That's exactly
right?
What we want.
If you're not familiar with Realty Mogul or CrowdStreet, both of them are vehicles. And I talked to the marketing director for CrowdStreet just about 3 weeks ago. He says some investors have invested tens to $20 million in their platform. Right. So these are platforms that allow you to, and I signed up for CrowdStreet just because I was like, I don't know how this works, but it allows the individual investor, quite, accredited to participate in more real estate than they would have in the past. I'm not going to get into the whole blockchain thing, but tokenization, this little clip I have in the right, fractal property buying tokens in real estate is a thing. They're actually, this is a true website where properties are tokenized and sold out as well. And then I just was listening to a podcast the other day. I don't know if anyone's familiar with Picasso. So Picasso is basically the fracking of second homes. So he says, so second homes, the founder of Picasso was the former CEO for, for .loop. And Picasso allows to take a second home and divide it into shares. And, not kind of like call that, timeshares, but in a little bit different. But it allows you to derive more income out of the same piece of
Can I call you back? I'm in class.
I think across the board, the dividing up of real estate is an interesting trend that's going to continue, and it's going to allow more people to invest in real estate. All right, let's get to the questions in a second. Adaptive reuse, we talked on this earlier. I think across the board, retail, as much as I pointed to positive trends in retail, I don't know, the Santa Anita Mall, is it still doing well over there? I can't remember how the mall was doing. It had a kind of a down cycle. Is the Santa Anita Mall doing okay?
No, Naveen, I didn't come this time.
What's that?
It's not a mature man. How
Yeah,
is it?
I'm not sure I understood, but I'd say most of there's still parts of retail that are overbuilt. America, as on a comparative basis to Europe, we have 23 square feet per person of every person in the country in the U.S. compared to 5 feet per square foot per person of retail in Europe. So we either are overbuilt or under demolished, depending where you are in the country. And so there's still a lot of now things like medtail and other uses are going to make up some of that demand, but things the large scale retail, the businesses that have been decimated, I'll call it, from the Amazon I'm talking and the Amazon guys ringing our doorbell right now. So that just tells you how I live. But in any case, that's a challenge for retail. Office space we talked about earlier. Hospitality, well-located hospitality. I mean, the business hospitality space is still challenged, right? If you've taken a vacation, you probably noticed resort hospitality is doing just fine. But business hospitality, I think if you're a downtown LA hotel right now, or you're any other hotel that relies on convention or business travel, still struggling. We sold, one of our counterparts in Texas recently sold a hotel that's going to be converted into workforce housing. So kind of longer term rental, but in a converted hotel, which I thought was kind of interesting. So there's a lot of kind of redevelopment opportunities. I think on office space, just to go back a touch, the really opportunity is to take those buildings that were built pre-1990 and think if they can be reinvented into residential, because that would satisfy some of the residential demand, right? Of course, cities have to allow zoning and all that other stuff and parking and all that other jazz that goes with it. But that's one opportunity, trying to identify more opportunities to develop office space. And then housing, again, we talked about a little bit. We talked about single family rentals, multifamily investments. I don't know, some of you do multifamily sales. Again, there's just not enough product to buy as an investor. There's not enough apartment units is on the high end example I gave in the rental rate increases. I'm frankly surprised. I look at a city like Chicago where I live and I see all these, there must be 12 cranes downtown building, 400 or 500 unit apartment buildings. And I keep thinking, who's buying? These apartments are not inexpensive, right? One bedroom is $3,000 a month, right? $2,000-$3,000 a month, but there's just not enough space. So the demand is there for sure. So land prices are high. I mean, land prices continue to go up, particularly if that land is developable into housing or industrial. If the land is the potential for either one of those things, there's a buyer out there for that land. And then, there's all the other variables. So Peter kind of sent me a note about some of these things, so we talked about excess office space, but here's the other things that's kind of facing. I talked about the cap rates and the interest rates. Well, here's the other thing a developer investor's facing: cost of materials, right? I don't know if anyone here has done a home remodeling project or is involved in cost of materials is unpredictable for one and quite expensive for the other if you try to procure something. Supply chain problems. I think there's down the street from me, there's a large multifamily complex going up, and I was chatting with a restaurant owner and said, oh, it's delayed a year because they can't get the supplies to finish building it's still going out of the ground. It's not totally, it's 2 floors. It's probably going to be 4 or 5. They cannot get enough. So supply chain. So think back to that chart on cap rates and interest. So you have the risk of I may not get the return, but now on top of it, I may not be able to finish my project on time. And as a developer, you can imagine that's not a good scenario. Get a hold onto that project, waiting for it to come online and start paying rent, right? Labor shortages are an issue. We see that when you go to every shop you go into, it usually says help wanted, right? But it's particularly acute in the construction business. And then there's the question of either eviction moratoriums, expirations, or new rent control initiatives, depending on what side of the argument you're on, or that that is causing doubt in the marketplace for investors. Now, I will tell you from my perspective, it's really hard to work around things like cost of materials and supply chain because those are so unpredictable. What I tend to see in the problems with eviction moratoriums or rent control is not the fact that they exist, the fact that it's the government, the politicians play with them and they don't get decided, right? So once there's a decision made, everyone knows how to okay, I can either raise the rent or I can't raise the rent, or here are the rules. But it's not knowing the rules that creates a lot of uncertainty for investors. So I think, again, I don't know the rules in Southern California. Personally, as a trained economist, rent control tends not to work. It's been proven time and again, but it's very politically popular. But even if it's the case of we're going through a phase of embracing rent control, investors will adjust. They just need to know the rules. They just need the rules that they're going to play by. Because then they will decide what kind of properties to buy. And to the point earlier, or they may choose to invest in other markets where there isn't rent control, right? Money's very liquid. Money can move around. And then last, the other extraneous variables are clearly energy costs for owners and operators, right? Because of the global conflict. That said, with the global conflict in Ukraine and Russia and other uncertainties, it is still driving a lot of investment dollars to the U.S. because despite everything all these other things I've mentioned, the U.S. is still a very attractive place for investing in real estate. I mean, across the board. I don't know, some of you probably represent buyers from Latin America or Asia. You can tell me if I'm crazy, but I think despite the uncertainty, I think people still look to the U.S. as a good place to park your money. Would that be a fair thing to say? Yeah. So especially if you've worked with overseas buyers. Yeah. Steve or Alex, do you have anything to add to that? No. All right. That's my point. It's just so despite everything out there, all the uncertainty, there's a lot of liquidity in the market, a lot of dollars chasing deals, and there is still a lot of foreign interest in the United States. Inflation generally is a good thing for real estate, and that people look at real estate as something that appreciates in times of inflation. And if you own rental real estate, and as I said, if you're in commercial, you tend to tie your leases to CPI and things like that. It does provide you some protection, right? Because your income stream can go up in line with whatever the long-term inflation rate may or may not be. All right, so Peter, those are my comments for today. I'm happy to chat about anything I shared. Hopefully that makes you kind of scratch your head and wondering like what you should be advising your clients or personally doing. I'm open to your comments as well.
Dan, you mentioned that eviction moratorium is if the investor can follow the rules, then they're okay, But the matter of fact is in California, the politicians always change their rules.
Well, and that's kind of my point.
And we can never follow their rules.
That's kind of my point. It's not this is personal opinion, right? It's not the fact, there is an impact to rent control. There's an impact to moratoriums, right?
Yeah.
And if those rules were in place permanently or for long, then you would adjust. You would know what to do, right? But when they're constantly played with, that provides uncertainty. Now, here's an alternative. So what do you do if you're an apartment owner and you're saying, screw it, sell my apartment building. I'm going to invest in self-storage. Self-storage, I don't have to deal with people, right? It's still, if you listen to podcasts at all, we had an interesting podcast about 3 episodes ago with the founders of KO Storage, and they're a big investor in self-storage that have kind of built a business based in Minnesota. They're now in 37 states. And one of the things the CEO or founder said, he's like, I just didn't want to deal with people anymore. I can run a storage unit, without having to see anybody and have to deal with the complaints about the sinks and the toilets and anything else, right? So people have, people who are investors have preferences in reaction to things like moratoriums.
Mm-hmm.
Great.
Yeah, thank you. What about live and work? And nowadays, people don't want to go to work, and also the gasoline is so expensive. So the natural tendency is for them to, stay close to where they live and work.
Yeah, I think that's fair. I think, as I said, you see the demand. The people are perfectly willing to go out to eat, right? That's what I see. So as I said, that's kind of funny to me, right? On the one hand, you don't want to go to work and you don't want to spend gas to go to work, but you're more than happy to drive out and go out to dinner. I think one thing that it's and I don't have the facts on this, but I saw this in a recent presentation, the demand for sort of mixed use housing and life and work is the trend of developers. So in other words, like I'm trying to think something in your area. I'll take like what used to be the Pasadena and shopping and rent. So people, there are developments now where people like to, okay, I live here. I have daycare over here in this building. I have a co-working place where I can go and sit during the day to get out of my house, and I can eat over here, all within a very short distance of myself. So it's kind of urban living, but on a more micro scale. That seems to be what developers are pointing to as a trend today. So to kind of, they don't have to go to work, but they don't want to be stuck in their house either, right? You still need childcare. You still need, co-working or places to go to work during the day. And that seems to be a trend right now. As I said, I'm still would always hesitant to talk about these workforce trends because people's memories are short, right? And, trends can change pretty quickly, I think. And remember, don't forget, after 2000, 9/11, people said no one would ever want to work in a high rise again, right? And yeah, that took be it the Willis Sears Tower or whatever, One World Trade Center, no one did. But then time passes and people forget, right? Or people become more accustomed to the trends.
Yeah. And also then in states like California, where you have a very acute problem of housing crisis, they are thinking of converting the office building into residential houses. Yeah. And they are trying to expedite this by easing the zoning requirements. What do you think of that?
I think that I think that's a great answer in large part because owners of, if you're owning an office building and you're like facing tenants that are going to be moving out to expiration of your lease, and your building can be adapted, why not? Right? I think you're right. There are other issues like parking, right? When your parking ratio for office is different than parking ratio for residential, but I think that's
and the plumbing, the conversion can be very
right. But I mean, look how many old, maybe not in California, but like old warehouse buildings became loft apartments, right? That's a trend, right? Those are 1920s construction became loft apartments that are very desired. So to my point earlier, why not take a 1970s or 80 office building and convert it into housing if you can do it? That's a good reuse of space, particularly because you might get the returns because rents are high in housing today, right? Demand is high. But it comes down to zoning issues, right? I think, this is just again, personal opinion, but cities and municipalities are going to have to get a lot more flexible on zoning, right? They used to be very prescription about, we got to have office here and retail. People don't necessarily want that anymore. People don't care as much, right? They don't mind mixing housing with retail and other uses. As a matter of fact, I'll take you in Northern California. The mall that was in Richmond, I think Richmond, California, kind of north of San Francisco, right? Prologis bought it. Prologis is the world's largest industrial developer and owner. They bought it. They're converting it to residential, retail, and industrial, all three uses in a former mall, right? And the industrial, you're saying, why? Why do you need industrial near residential and retail? Distribution. You need to get those packages there as quickly as possible, right? So when I say industrial, I'm not talking about coal burning plants, right? I'm talking about what we've all grown used to, which is I order today, I want my Amazon package tomorrow. And how do you get it there? You need industrial space. And if I don't know if it's reached Southern California yet, but here in Chicago and in New York, you have services that deliver in 15 minutes. 15-minute grocery delivery. 15 minutes. So you get on your phone. And then, by the way, it's a good use of a vacant, retail space. So what they do is they go into a retail space and it's not open to the public, but they just stock it with all the most purchased items at Ralph's or whatever. And you get on your phone, you're like, I'm cooking, I don't have any eggs. And I say, I want eggs. And they put the eggs and they get on a bicycle or a car in your area and they deliver them in 15 minutes. So that's just that's just attention spans getting shorter and shorter. But there's a company called Getter, Getir, GoPuff. If you have kids in college, by the way, does anyone have kids in college that use GoPuff? I know I do. GoPuff delivers alcohol. in 15 minutes or less. So if any of us are old enough to remember in college when you go to a party and they would say, someone's got to go to the liquor store, just saying, right, this might happen. But no one has to do that now. They just go on their phone and go to GoPuff and get it delivered.
Hey, Dan, let's talk about inflation.
Yes.
The Moody, as a matter of fact, at the beginning of the year or maybe end of last year, they are predicting the inflation should be under control by the year of 2023. But they put some wild card, say, such as the pandemic, but they will predict the war. So seems as of now, this war is impact the supply chain of the whole world.
Yeah.
Probably not many people aware about Russia also, export lots of lumber. So that's not helping. So with that, I see lots of countries all over the world, they have a problem with inflation. Do you see any kind of, maybe this is, I should ask the politicians, and their answer is never predictable. If we keep on, Federal Reserve keep on increase the overnight fund rate, then that will definitely have an impact to this. For my own observations, commercial, real estate, the cap rate, yeah, I can see very unusual cap rate keep on compressing while the T-bill is gradually going up, and then sometimes, yeah, you say that is right. If it's the closing, then we are going to have a big impact on the commercial real estate.
Yes.
How do we? I don't know how I'm struggle trying to find the answer on this,
Yeah, I mean, I'm not an economist, and Steve, I don't know the answer. As I said, we're having NAR economists speak to us in June, so stay tuned for that. You could ask the question. I know we had the Moody's economist last fall. And by the way, I just posted in both the Facebook group and our LinkedIn private groups is it Moody? I think it's a Moody's conversation about the impact of the Ukraine-Russia conflict on commercial real estate, something like that. It's next. It's the 25th, whatever the 25th is of this month. So, I mean, that's a good question, Steve. I don't have the answer. I think until recently, people kept saying inflation is, supply chain and it's going to even out, and it's not clear that that's the case now. Right, and that was why I showed you that chart, as you were pointing out. Like the more that those T-bills keep going up and cap rates come down, we're going to run into a point where people don't want to invest in commercial. It doesn't become economically smart to invest in commercial real estate, or you have to invest in a certain type of asset. Like, as I said, a value add. It's going to drive investors to value add and things like that, as opposed to stabilized assets.
Yeah, Moody have a webinar yesterday regarding this kind of, Ukraine war. I still have to go through the recording once more. It's 1.5 hours.
Yeah.
Yeah.
So, yeah. So I don't know the answer, but it's obviously a good. But that, again, that said, inflation tends to drive people to commercial real estate only because it's a hard asset, right?
Yeah.
But
yeah, because if you are looking at this morning's CoStar, the news is talking about all this inflation already starting to have an impact to the consumers' confidence and some retail sales.
Right.
Yeah.
Yeah, absolutely. Thanks. Other questions, observations? You're always an in tune and astute group, so I appreciate that.
Very enlightening presentation, Dan. Very good.
Thank you. One thing, Peter, one thing I always say is, I always tell brokers, don't get too obsessed about all the trends. Yes, there are all these trends, but your job is to find opportunities for clients. There are always opportunities out there. There are always opportunities out there, right? Things change, and they don't feel like the markets, don't be dictated that the market doesn't deliver, because there's always opportunities, and our jobs as commercial people is to find those opportunities for clients.
Yeah, you're
Oh, can you hear
absolutely
me?
right.
Hello?
What did you say, Steve?
What I say is, Dennis is absolutely right. The one who can find out what we can see, not ordinary people visualize the opportunity. They are the winner, but I'm not.
That's our value. That's our value. As things
Yeah.
change, to find those opportunities.
I always get a question from my agents and say, hey, do you think there will be a crash in real estate since the war is going on and COVID and the economy is tanking? And what is your thought on that, Dan? Maybe
I don't want to be quoted here. I truly don't know. I truly don't know. I mean, I think the U.S. economy, just in what I've heard, is pretty resilient, right? It's pretty, but Steve brings a point. There's a herd mentality when people stop. We're a consumer-driven economy in the U.S., right? If people start to think things are getting bad and they stop spending, that puts the brakes on the economy for sure. But real estate, as I said, real estate's about opportunities. And I just believe there's, the worst thing for real estate is when people can't make decisions, right? But if the market should go down, which it will at some point, right? Then there's opportunities to buy, right? If the market goes up, it's selling and reinvesting. What you just don't want in commercial real estate is static, where things don't change or people are uncertain. That just kills the market. But as long as there's change going on, there's a need either people to get into space, out of space, you have a demand, and that's all we need. And our job is to fulfill that demand.
Yeah. Well, as long as the real estate is not in a distressed state where the owners cannot make a mortgage payment and they don't have equity and in the real estate, and that's really the time that we have.
Yeah, although in residential, it's absolutely the case. But don't forget, there's so many commercial loans. I don't want to make light of this, but for a commercial developer to give the keys back on a property, it's not his house, right? It's not. I mean, it's an economic impact for sure. But there's a property here in Chicago just this week. The lender just said, I give up. I'm giving them back. They write off the loan, but at least you're not putting someone on the street, right? I guess the tenants are still in the building, right?
Yeah.
And that's an opportunity for someone to come in and buy it, right? Because they're going to have to mark down that value of that asset.
That's true. That's true. Very good.
Hello, can you hear me?
Yeah. I don't know who's speaking here, but
hi, yeah, I'm Xavier. Hi, Dan.
Hi, Xavier.
I think to Steve's point, with interest rate, increasing, the 10-year is already at like 2.844, which is 130 bips above where it was at last year. So that's already significantly up. And Steve mentioned that the Fed has already increased interest rates 25 basis points just recently this past month, and I think their plan is to continue to increase interest rates throughout the rest of the year to battle inflation. I mean, for me, intuitively, I would feel that at some point cap rates would have to start to expand at some point, and that's just my intuition speaking, because there has to be some sort of what I call risk premium, right? There has to be that buffer between what an investor's yield should be versus like the standard investment benchmark, which a lot of people view the 10-year to be just that. So I don't know. My intuition is that at some point, as rates continue to increase, cap rates would have to kind of, move accordingly, I think.
Yeah, no, I think Xavier, you're and that's why I shared this chart with you, right? I just put it back up. Hopefully you can see it, right? 10-year treasuries in orange and the cap rates. Now you just brought a point up. So they're at 2.8%. So now that gap is a lot closer, right? I haven't updated it through March. So that gap is a lot closer. And yeah, something has to give, because you can see the last time it was close was July 06. And, we know what happens, 12 months after that.
Right.
So that's a good point.
But like to share with you, don't bet on that, because last time I hear webinar sponsored by the Walker Dunlop, and there's a professor mentioned about the cap rate has nothing to do with the T-bill, nothing to do. They are talking about the money supply. and this professor probably some kind of maybe letterman or something like that, I had to dig out to it. And he said that probably before the pandemic, and he said the cap rate will be compressed and nobody trusts him. And it ended up the cap rate has been compressed, And this year, probably sometime last month, he also mentioned about cap rate have nothing to do with this kind of long-term T-bill. It's regarding the money supply. So, which is I still find it's a little bit hard for me to digest. For me, interest rates is outgoing, income being compressed, and your outgoing is going up. You are going to have some growth somewhere, So I'm very interested to see. I need to go back to hear what he said again. But he mentioned one thing is related to the money supply.
Yeah.
So
I mean, Steve, you're right. I mean, ask 3 economists, you get 3 opinions, right? So you don't truly. I mean, cap rates. The one thing about cap rates is just a measure at a point in time, right? So that's one thing, that the limitation on cap rates. But I think if you look at the trend of the gap between the two, there's some historic precedent for what can happen, right? And how investors make decisions. So.
Yeah, absolutely right. Because if you see some of the multi-units, their cap rate is ridiculously low. How can you justify that? And they have a theory talking about, because we are looking for the future. Cap rate is right now.
That's a great point. Look towards the future, or that without rent control, like I know, because there's no supply, I can raise rents 10% a year for 3 years. Well, that makes a big difference, right? That makes a big difference. So there's, that's true industrial space as well. Like their rents will just go up because there's no space out there. So despite what the price gap is at the point in time, the investor looks at the future, right?
Okay, I think the hour's up, and I'm sure that you have a lot of other questions for Dan, but nevertheless, we have to conclude this meeting. If you have further questions, you can direct it to Dan by his email, or even call him.
I'm friendly, as Peter says. I'm friendly
to talk to. So, okay, Dan, thank you so much for coming back to talk.
Thank you, Dan.
And
always pleasure to talk to you guys.
Yeah.